Hi, everybody, and welcome back to yet another cracking installment of the Map Round Show. This is the Private Placement Perspective series, where we're connecting you to venture capital firms, guys managing money and taking the risk on early stage investing. With me on the line is Kyle, the fund manager, the main honcho, the man, the legend from Backswing Ventures. Kyle, welcome to the show.
Yeah, thanks so much for having me, Matt.
It's good to have you here, man. So could you kick us off, please, and just give us the background of Backswing Ventures? Like, how did that all come about? What's the origin story around that? And how did you get your start in the world of venture capital investing?
Sure. So I'll go with the start first. I was always interested in financial markets. When I was in college, I worked for Duff & Phelps, which is a leader in financial advisory and valuations. I interned for a hedge fund, worked for a couple of different investment banks. So I was always into investment banking, kind of high levels of finance. Is something that was interesting to me. In January of 2018, I started a firm, BX3 Capital, that was an advisory firm, actually really in the cryptocurrency space, providing a lot of advisory to investment banks and different early stage companies in the space looking to get a start on how to navigate the capital markets. I exited that in October of 2019, and I launched Backswing in February 2020, right before COVID. With a little bit different of a model than most venture funds. I want companies to be profitable in 18 months, and I want to see $1 million in revenue. I'm not as concerned about growth rate. And I just had a really specific criteria. Had a first fund, did 8 deals, did really, really well. We returned a good chunk of capital. We have, a significantly marked up portfolio. So I just launched the second fund. It was a very easy fundraise, and we're actually going to be funding our first deal tomorrow. So,
congrats, man. That's awesome. Tell me, what's your typical check size? I know the fund's relatively young, which is a good thing. So what would you typically look to cut a check at? And then who are you looking to back? Like, I know you mentioned you looking for a bit of traction and that kind of thing. But
so our typical check size is $500,000. That's kind of what we look to do. The idea is you have a $15 million fund, you pick 10 to 12 companies, you write $500K initial checks, and then you get right of first refusals to follow on in later rounds. So you kind of get to double down on the winners. That's kind of the model. That'll probably be an average. I'm sure there'll be checks we write that are 250. I'm sure there'll be checks we write that are $1 million, but the average will come out to about 500K depending on round sizes. That's just based on where we are. And as far as what we look for, it's really simple criteria. I look for companies with $1 million in revenue. That de-risks them to me because it shows that there's product market fit. I mean, there's a ton of cool products out there that you see online, you go to conferences, but no one actually wants to buy them and pay for them. So the $1 million in revenue is something I really like to see. Then I look for companies valued under 20 million. Really like companies under 10, because you look at a company under 10 million. For a company to go to 10 to 50 million to make 5 times on your money, is it tough to do? Yeah, it's tough. But going from 100 million to 500 million, I mean, there's only a handful of companies in the world that are valued above 500 million. So that's much tougher to do at the later stages, and there's a lot more risk involved. As we're seeing right now, the later stages are getting bullied. So we look at that, and I want companies that are going to be profitable in 18 months with investment. That's what I tell them. Again, does it always happen? No, but that's what you want them to be focused on, because ultimately, if you want them to not have to use capital markets constantly and become good cash flowing businesses that somebody's going to want to buy, they have to get to profitability.
Yeah, I agree with you. What would you say makes you guys different? And there's a lot of talk about, value added venture capital firms and things like that at the moment. What would you want startups to know about your investment firm that makes you guys different?
Yeah, sure. So uniquely different is we're actually not that hands-on with our management style. My background's in finance, so we take board observer seats because we like to know what's going on, but we're not overwhelmingly hands-on from a management perspective. And, one thing we're really helpful with is one thing that founders absolutely hate doing, which is raising money. My background's in finance and raising money. So that's one thing we help the portfolio companies out with a ton, where we're not overly invasive from a management perspective. And we found, to have really good relationships with our portfolio companies.
Kyle, please, could you give us a sense as to how you approach, the world of venture capital in a macro economy that's, let's just say, tricky? I mean, we had SVB, 40-year-old investment bank, over $200 billion worth of assets, literally go bankrupt in about 36 hours. I mean, that's pretty
Yeah.
insane. So,
I mean, I think that, from a macroeconomic perspective, I've raised a fund now. My first fund I raised on the onset of the COVID pandemic, and my second fund I've raised basically when we're seeing a regional banking crisis. I mean, it's fair to call a regional banking crisis. I just read that the Fed, that $300 billion facility they set up for banks, $148 billion of it's been drawn on already. So there's definitely a regional banking crisis out there. But I think one of the nice things about venture capital is there's duration to it. So it's not mark to market every day, where if you're a shareholder in First Republic, which is tanking right now, you're like, oh my God, what do I do? Do I sell and realize my losses? Do I sit here and watch it go down? Do I buy more and hope it comes back? You're kind of hopeless. And most investors tie themselves up into a pretzel thinking about it. Where if you're in venture capital, there's no mark to market, no company's failing tomorrow. It's over a period of duration that transcends economic cycles. I mean, most of the exit periods on investments, a short exit is going to be 2 to 3 years. A long exit could be 7 to 10 years. So these things are going to go through economic cycles. And that's why it's nice to be a part of an investor's portfolio, because it's not mark to market on a daily basis. But going back to what you said about Silicon Valley Bank, I honestly think, and I did a lot of work on their balance sheet over the weekend, their depositors would have got back about 90 cents on the dollar. They weren't actually that insolvent. They got hit with a bank run. And there's really no bank, if even JP Morgan, as strong as they are, if every depositor went to JP Morgan right now and said, I'm moving to Bank of America, they'd be belly up. I mean, they lend out money, they invest money, and that's how banks make money. But no bank could afford to have a redemption of 80, 90% of their deposits. I don't know what the right ratio is for banks, but I bet you most of them couldn't survive 40% redemption on deposits.
Yeah, your point though is taken, and I actually really like that one about probably the best points I've heard around how how much you're thinking about the economy. And your statement was, which I love, is well, if you're going to cut a check for an early stage venture, you're on a 10-year cycle, right? So in that 10-year cycle, to your point, it's guaranteed you're going to hit some shit. Like there's going to be a regional banking crisis, or Web3 won't really arrive for another 10 years, or AI does X, or you know what I mean? And somewhere in that return on investment journey to your LPs, for instance, there's going to be some kind of major systemic event of some kind. You can pretty much bet on it. So if you know that to be a truism, or a probability that's worth considering, then it plays less of a role. You know what I mean? In terms of how much does it really? Well, it doesn't matter. There's some fundamentals about businesses. A problem that really matters: big opportunity, great team. Develop all the stuff you would usually expect, because then it's really about, if you have a great foundational system or business or people, you're able to circumvent or mitigate that macroeconomic risk to an extent.
Of course, yeah. And I think that's what you said. People are the most important thing in the whole equation. When you're looking at the founders, they're driving the bus. You're along for the ride. You have to really be confident in the people you put money with. And yeah, I mean, if you look at ventures, relatively new, right? So call it from 2000 on. There's, if you started in 2000, you had the tech bubble. Then you had a period of years where things were pretty calm. You had 2 wars if you're a U.S. investor, and then you had the financial crisis. Even that period from 2010 to 2020, at the tail end of it, you had COVID. In the middle of it, you had the European sovereign debt crises, where Bank of Greece and Italy were going bankrupt. You had Brexit. There's a lot that's gone on, and these companies and funds have transcended these economic cycles. You just have to know you're going to have it. And sometimes the timing works in your favor, sometimes it doesn't. But that's the nice thing about venture. If you can afford to have money to be illiquid for a period of your time, if you're in a venture fund, you're ideally going to get a pretty good return over that time period.
Yeah, absolutely. Kyle, let's quickly talking to LPs. So when you raise a fund, what do they care as much about the macroeconomics as maybe the fund manager does, or the GP at the VC firm? Or are they kind of like, I've got enough cash to lose, I'm going to put 10% at risk on super risky venture investing. I reach out to you, give you whatever the amount is, you go off and manage and invest it. So do they care as much as you do when it comes to the macroeconomy?
Great question. So it's kind of a double-edged sword, right? Because a lot of my investors, all my investors, are family offices and high net worth individuals. So for most of them, you have people who their equity portfolio performs really well, and they pull some of that money off the top of their equity portfolio and they invest it in venture. Those guys care a ton because they say, oh man, markets are down. I don't have as much capital to deploy. I don't know about this. I'm in pain. And then you have other people who are like, great, recession, downturn, opportunity. I don't like watching my money go down in the market. I want to get it somewhere where I'm going to get a return over a period of time. I don't need the money. So it's a double-edged sword. You get it both ways. You get people who you don't want to call and talk to you every day about the market. You get the people who are like, they couldn't tell you if the market was up or down in a given year.
How do you find family offices or high net worth individuals are easier to work with when it comes to, building a $15 million fund or whatever?
It's really your only option. And I kind of learned this on the first fund. So the first fund I set out and said, okay, I'm going to raise 50 million. Bad idea. You're in this kind of like death valley, right? Because a family office, the biggest check they're going to write, probably $5 million for the most part. Again, there's some really large family offices out there, but your average family office with, call it $50 to $100 million in assets, single venture fund, they're not writing a check bigger than 500 or 5 million. And if you talk about individual investors, high net worth, single guy, it doesn't really matter how much money they have. They're probably not going to write a check bigger than $1 million, unless they're worth, over 3 to 500 million. Then their check size starts to get a little bigger. But if you're worth less than 100 million, you're not writing more than $1 million check. Probably going to do 250 or 500. So you think about that, right, in the fund makeup. But if you go to 50, all right, now you're targeting pension funds, you're targeting retirement funds, you're targeting, endowments. Okay, they like to write checks that are 15 million plus, but they don't want to be, 35% of your fund. They don't want to be more than 10% of it. So you look at it, you say, well, if I want to target those investors, 50 million, my fund's too small. I got to go to 100 million. And then you need a whole different group of connections. Those have to be your connections: pension funds, institutions, massive fund of funds, big investment banks. And you need a track record to do that. I mean, no Goldman Sachs or a big investment bank is very rarely going to invest in a first-time fund. So you need to work up to that. That's why I think that somebody told me the average first-time venture fund is about 3 million, which is a really realistic number because you're raising money from people who know you and trust you and have a relationship with you. So, the one piece of advice, if there's any, aspiring fund managers out there, I'd give them is when you go raise a fund, raise something on your first fund, either above 100 if you have those connections, or do something below 20 million where you can take the individuals and family offices and fill up the fund.
So let's say, day one of your let's go and raise some money for fund one, and assuming you just had a thesis, but you didn't really have any track record to speak of or whatever, where does one start to find a high net worth individual? Like, are they lying around on Silicon Valley park benches, or probably? But walk us through, like, in the context of raising a fund. Like, how does one? Like, I don't know. I've only been in the States for let's just say 8.5 months, so I know fucking no one outside of the people that have been on my show. So, like, if I wanted to now raise Matt Brown Show Fund, because it's awesome, how does Matt Brown or anybody else trying to raise a fund for the first time? Because there's an explosion of this activity lately from my conversations with people. But if you don't have the network, where do you start?
So again, I was fortunate to grow up in New York City and work for a bunch of major investment banks and grow up, on the footsteps of Wall Street. So I made a lot of connections working in, New York City and working in investment banks, but I'm also a big golfer, right? So I'm a member of Trump Edminster up in New Jersey and Isleworth, where I live here in Orlando. And, I've been fortunate to cultivate kind of a great network of high net worth individuals I've met on the golf course, which is partially why the fund is named Backswing Ventures. So that's kind of been a route for me, is working on Wall Street. And I've met a lot of people playing golf. People have networks. They introduce you to friends. They introduce you to friends of friends. And that's where I've raised a lot of my capital from. So that's part of, what's behind the name. But that's how it's been for me. But yeah, I mean, you got to build relationships with people, and you got to start somewhere. I mean, if you have a track record and returns, as I've built on my first fund, people will come to you. People will come out of the woodwork and start finding you. But on the first time fund, you're asking people to trust you, really. I mean, that's what you're doing. So they're probably not walking down the street, but I mean, you got to go through your network, go to networking events, go to conferences, go to venture conferences, meet funds, intern at funds, do as many things as you can to get yourself out there. I have one LP who tells me all the time, life's all about showing up. That's really, really true. You have to show up, and you have to talk to people and meet people. And that's that's how you kind of cultivate a network of capital.
Mm-hmm. Great. I'll start tomorrow. Righty. So I want to change gears quickly and talk to you about how you evaluate opportunities and manage risk. So how do you find deal flow, for instance? What's your typical source of deal flow? And then when you find it, what factors do you work with to consider or not to cut a check?
Sure. So deal flow, we see an overwhelming amount of deals. I'm sure after you publish this podcast, I'll see even more deals. So thank you for that. First and foremost is people reach out to me, right? People go to our website, my email's on there, people send me deals. I love seeing them. Some are good, some are not so good. We see a lot of deals. Some of the best deals are from other funds we work with. Maybe it's a little too early or too late for a certain fund, so they share it with us. Funds share deals all the time. We have a fantastic law firm who shares deals with us. We have a large accounting firm who shares deals. I know a lot of lawyers and accountants just generally in the venture space who share deals. Of course, going out to conferences, speaking on panels, people reach out to you, doing media appearances. We just had an article about us in the Orlando Business Journal. Probably saw about 30 deals just off that single article. So I see deals from all over. You can never see enough deals. But, with that being said, from a founder perspective, it's kind of a tough numbers game because I told you at the beginning, I'm probably going to do 10, 12 deals on this fund. I've seen 10, 12 deals this afternoon. You see so many deals, so that allows you to be so selective and really find what you like. And for me, how I look at it, the biggest thing is the founder, right? Are you comfortable with this person? What makes you think they'll be successful? What makes you think they won't be successful? I mean, you really have to get to know the people, what drives them, and how they're going to grow the business. The founder is always first. I don't care how good the product is. If the founder or the team managing the product is full of idiots, the product's never going to get off the ground. Next thing that comes is the product, right? Is it, I find things that would be, wow, that makes sense to me. Some things you just don't understand. That's why I don't invest in biotech. Aside from capital requirements and other things, I just don't understand how, vaccines work or created. I just can't wrap my head around it. It doesn't make sense. I can't explain it to an investor. I can't do it myself. So that's one of the things we really look hard at is the product. What's their competition? What's the growth look like on the product? How good is the product? How easy is it for somebody to duplicate the product? Then we look at the financial piece of it. Does it make money? What's their margin on the product or service? Is it good? Is it growing? Who are their target customers? Are they going to be able to achieve these target customers? Are they profitable? When will they be profitable? If they're not profitable, why not? What's slowing them down? And then, there's the general legal and entity formation checks. But those tend to be the big three, is the people, product, and financials. That's where the bulk of the due diligence is focused.
Got it. So where does it go wrong? I mean, if you're seeing so many deals every single day, I mean, I have nowhere near the amount of deal flow that comes. It's usually through my shows and stuff. Like someone will go, hey, we're looking to raise or whatever. But I don't get anywhere near as much, oversight as to because I don't have 50 million to put into a startup. So where does it go wrong? I mean, if you those 14 pitch decks that you looked at today or this afternoon or in that afternoon, where does it go wrong? Is it the way that they're not able to translate their story to you? Do you find they misrepresent their forecasts?
It's not really a story. I mean, without getting too into the Fund 1 portfolio, we've had 2 exits. And we don't have a single deal that's a loser in the portfolio, which is not common in venture. Fail rate's 90%. We don't have a single deal that's a negative deal. So that's that's something that's pretty unique to our fund. We have 1 deal. I assume we might end up just getting breaking even on it, but I don't think we're going to lose money. So we had a really good portfolio. The model works well. I think that where things go wrong. I think as an investor, one of the things I think about is, every deal I'm going to invest in, I think about how does it go wrong before I invest. So I sit there and say, okay, 2 years from now when this thing fails, is it like an aha, this is why it failed and I knew that? Or is it wow, the biggest thing you always come back to when you have a really good deal and you want to invest it is, well, somebody makes a better product. And that is generally true for any business, right? I mean, think about being an investor in BlackBerry, in the BlackBerry phone, in the parent company. I think their ticker symbol used to be RIM. think about investing in them in 2003 or 2004 pre-iPhone. I mean, you probably thought you were the smartest guy in the world, right? I mean, how could BlackBerry lose? It was the business phone. Every business professional had a BlackBerry. They could email, they could BlackBerry Messenger. If you didn't have one, you weren't serious in business. Then the iPhone comes along and BlackBerry disappears, just wipes you out overnight. Like that can happen. I mean, that is the ultimate risk to any business, is somebody builds a better product. Right. I mean, Netflix was first, and then every other streaming service came out and they just chipped away market share. Netflix has held their own, but look at MySpace and Facebook. Again, you're a MySpace investor, genius. Facebook comes along. How did it happen? So that's, the one risk that you always come back to on a good deal. But, when you think about a person, if you're a little bit uncomfortable with them or a little bit uncomfortable with anything, you just don't do the deal, especially when you see as many deals as we see. I bailed on deals at all stages of the conversation because you become uncomfortable with any one thing. And when you run a fund the way I do, you're fortunate enough that you can bail on any deal you want to, really, because you have so much deal flow and you have the ability to replace it with something that's better, or at least you perceive to be better.
Yeah, it's well. Firstly, congratulations on not having a rotten egg. That's like a super rarity.
Yeah,
it's actually like the VC thing, right? It's like, cool, I'm going to make 10 bad bets, but number 11 is my guy or my girl. That's the one that's going to. And by the way, it's actually not the 11; it's number 3 that they never thought would scale. And it's like, oh shit! Now we actually got 95% of our returns from that one guy.
Yeah, win big, lose big. I mean, that's the model.
So what has been your biggest success? I know you mentioned you had a couple of exits, but what has been your biggest success, Kyle, and failure when it comes to the space of venture capital investing? And what would you put the difference down to?
Yeah, so I think the biggest success is having a model and sticking to that model. I think that's really easy to say when you're starting any business, is here's how I'm going to run my business and this is how I'm going to do it. And I think it's tough to stick to that model because, you're saying, all right, I'm going to start a fund. I'm going to get $15 million. You have one way you think you're going to do it. And then everything just goes to shit. Or, there's controversy, there's, adversity that you don't expect. And you just got to stick to that model. And that's when you have a model that works, you got to stick to it. And, the proof is in the pudding. The returns on our first fund are good. And I think that is kind of the biggest thing for me, is that we stuck to the model. Learning experience, honestly, I had never run a fund before. So it's not really a loss or anything like that. It's learning how to run a fund. Until you do it, you're learning the entire way. You're learning how things operate. It's one thing to read a book about them or talk to people about them. It's another to be in the chair and have to make decisions yourself. So the first fund has been a giant learning experience. It's been, mostly positive, some negative, but it's been a giant learning experience. And I learned something new about running a fund every single day. And, all that knowledge and experience is just going to make my processes better and the way I do things better moving forward.
Kyle, what's one piece of advice you'd like to give to a founder looking to raise VC money today?
Be who you are. I think I see a lot of founders who aren't genuine or trying to be someone else. I mean, everyone has a story and a background, and I like to hear that real story in the background, not the brushed up part of it. Just hey, here's my story, here's my background, here's why I do this, and here's why I'm passionate about it. And being authentic and genuine, I think is so powerful for founders because it helps VCs connect with them and buy into their story and what they're trying to build.
Yeah, it's really great advice. We need more of that in the world. That's my view. But Carl, we're going to take a quick break, and now we'll hear from one of our sponsors. The Matt Brown Show is presented by Carafin, an investment bank that offers and supports direct private investments in U.S. operating companies. Over the past 20 years, investors have placed over $1.2 billion of private debt and equity in more than 100 companies through Carafin and its affiliates. Carafin leverages technology to empower its community of investors to deploy their capital far more efficiently than ever before and connects their community of engaged investors with worthy companies. Invest portions of your portfolio in direct private investments today. Visit carafin.com/Matt Brown Show for more. And we're back. Kyle, you've cut a few checks, Fund 1 and now Fund 2. Do you have a preferred or most common capital structure for private placements? Or, is it like a safe note, pre-revenue, or convertible note? Do you price your rounds? Walk us through how you approach that.
So typically in venture, there's 3 ways people raise capital. One's going to be a price round, which is just a share offering. 2 is going to be a convertible note, and 3 is going to be a safe note with either some sort of valuation cap or discount rate on the valuation. I haven't come to have an extreme preference. I guess, a convertible note provides you a little bit of protection because until the equity converts, you're a debt holder. So you're senior to equity holders if the company fails or, gets purchased. But I would probably say convertible note price round and then safe note as my least favorite.
Your safe note's the least favorite. Why is that? You're like the opposites of everyone else. Everyone's like, yeah, we want to go safe. We go safe.
Yeah. I mean, they're not bad choices. I mean, the thing that with safe notes is the valuation caps are wonky and they're easy to get diluted. I mean, if you're in a price round and a company has 100 shares, you buy 10 of those shares, company can only create 100 shares. You own 10% of the company. When a safe note, some of those safe note conversions, I mean, you look at these cap tables and you're like, oh my God, it's like, you know how you always think about how lawyers write documents so only lawyers can read documents? Well, I feel like accounting firms that have gotten into the cap table business have created cap tables so only they can read them. I mean, there's like 100 lines for like 6 people. You're like, what is going on here?
Yeah.
So that's why I generally like price rounds. They're simpler. I don't think it's that much more work. I mean, I know the safe notes are generally shorter, but I would prefer a price round to a safe note.
And how do you price around? Because I had this chat now to Jesse Cole from the Seed Lab and I asked him the same question because as a founder, I want to get the highest priced round possible, right? That's the game. So, if I'm sitting here, you think I'm worth, I don't know, 10 and, I think I'm worth 20. You know what I mean? Like what factors do you go into your pricing around?
So, I mean, look, at the end of the day, it's all business. So you like founders and stuff, but you can jam people a little more on a price round, right? If you say you're worth 20, right, and I'm giving you money at 10, what's the time value of money? You have to go out and find somebody else to give you 20, right? In a competitive round, then the founder might have the edge. But if you don't have a competitive round, then I have all the advantage because you need the money, you need it now, and you need to grow your business. And you could go out and try and find money at 20 and never find it. So, I hold all the cards. You want to bluff? You got to have a couple of cards.
Screw you, Kyle. I'm worth 20, okay? Oh, that's funny, dude. But you're absolutely right. You're absolutely right. This is the thing. It's so interesting, right? Like you just get to a point where like, no, dude, it's not happening on your terms, right? This is it. Time, value, and money to your point. Like take it or leave it. But like,
yeah,
I'm your train and it's leaving. So get on board or don't.
Exactly.
Cool, Kyle. So when you think about the world of venture capital, what keeps you up at night?
What keeps me up at night? Man, that's a really good question, right? I think that, I guess you come back to competition, right? Who's going to build a better product and put out a press release if they launch this awesome product that's better than one of your portfolio companies? I mean, I think, that's it. I think that, a lot of people, what keeps them up at night is money related, right? I mean, if you're a company in the space, you need to constantly be raising money to grow. It's, sales. I think other funds, other funds make a lot of bets. We make bets in companies that make money. So, it's, again, competition's really our biggest risk to our portfolio at any given time. But there's a lot of, companies that have to worry more about the macroeconomic climate. And that's what you hear a lot in ventures, like the Silicon Valley Bank thing. I didn't have any portfolio companies that bank at Silicon Valley Bank. I didn't have any at Signature either. You can only imagine some of the phone calls I got on Friday afternoon of last week when, people were making deals and, they couldn't get their money out. I mean, that would be terrifying. But could you imagine you just raised a $20 million round and, your money's, you think your money's essentially gone, just totally gone. I mean, I can't imagine that feeling as a founder. I even said to somebody today, I said, the Fed didn't come in and bail out Silicon Valley Bank and Signature until Sunday night. But imagine on Friday, being a founder, having 15, 20 million in the bank. Imagine not being able to access your money, not knowing you're going to make payroll. Imagine some of the bad deals people made on Saturday and Sunday morning before the Fed's announcement that they were going to be able to access their funds on Monday. I mean, if you're a founder, you have to be doing something. You can't just sit there and wait. You can't just let your business fail in front of your face. You got to do something.
Dude, that's yeah. I mean, I cue the Netflix documentary, right? Because like, there's got to be one.
Yeah, for the 48 hours after Silicon Valley Bank, what I did with my business. I mean, there's probably companies bought and sold in those 48 hours, literally.
Next level, bro. You know, as I said, I've only been in the States for like 8 months or so. Only in America, dude, does that happen. You know what I mean? Like, really, like if it's like Silicon Valley Bank, like you couldn't set it up. Do you know what I mean? Like, and in literally 36 hours, like kaboom.
Yeah, but you think about like the movie, right? So like you think about Silicon Valley Bank blows up, then Signature Bank blows up. And who's on the board of Signature Bank? Barney Frank. And Barney Frank wrote the Dodd-Frank banking legislation in 2008 to regulate the banks so there would never again be a major bank failure. This guy is on your board. He wrote it. And then his bank is one of the two banks that blow up. And then you go look at Credit Suisse yesterday, right? And their chairman's founder, or the chairman of the board's last name is Lehman. Well, the Silicon Valley Bank CFO was a Lehman division CFO when they blew up. I mean, you look at all this stuff and like, you know, you always hear history repeats itself and you're looking at this and you're like, what is going on here? You've got the Lehman CFO, you've got Mr. Lehman, and you've got Barney Frank, and those three banks are blowing up. It's like almost like a simulation you're living in.
I reckon we are living in a simulation. I don't understand why it's so hard to. Yeah, I don't know whether it was Greg Becker, the CEO. Like I think, like when I when I think about it, it's kind of like I understand that you had like an overwhelming amounts of deposits, like 180 billion, and you wanted to get a return on it. Interest rates were low, and you bought treasury. But like that's fine, I get that. But I think from what I understand, where I think the story went wrong was in the manner in which they communicated with their customer base. That was basically the fuck up, because if they had said we've raised a round for 500 million, like if they just said that, and then they announced that they had sold those treasury bills at a $1.8 billion loss, then maybe there wouldn't have been the run that we saw.
Maybe. I mean, I think that Silicon Valley Bank was unique, and I haven't read that much about Signature yet because Silicon Valley is bigger, obviously, in the venture community. I think the thing that was unique about Silicon Valley Bank is that they banked mostly venture funds and venture funded companies. Well, now on a venture fund side, right? No venture fund holds that much cash in the bank because we call capital from investors, maybe hold a little bit for legal and accounting and operating expenses and management fees, but not that much. And we call capital from investors, money comes in, money goes out to portfolio companies. Well, these portfolio companies that mostly banked at Silicon Valley Bank, right? No other bank has single industry risk. I mean, not that bad. They have this concentration on all these venture-backed companies. Well, you had two things happen, right? Or three things. Interest rates went up, companies came under pressure, and funding went down. So now these companies are taking money out at rapid breakneck paces because the capital markets have slowed just on a normal basis because they're raising less and spending more. And then Silicon Valley Bank probably had their oh shit moment that, oh my God, our treasury book is worthless, not worthless, but it's severely declined in value because interest rates have went up so much. So we have these bonds yielding 2%. Well, guess what? The 2 years at 4. No one wants to buy this. They're not going to pay at a par. We can't get liquid selling our treasury book. They don't have a really big lending base as far as mortgages go because it was mostly a business bank. So it's not like they have mortgage-backed securities on the balance sheet. It's not an MBS crisis. So, they got stuck in a duration problem and a single sector risk. And that's what blew them up, is the combination of the two. And then, yes, of course, the Wednesday afternoon, I remember reading, I glanced at an article about, Silicon Valley Bank. They had this offering. They sold their bond portfolio at a loss. By Friday at noon, they were taken over by the FDIC. That's the fastest I've ever seen a bank fail. You think about Lehman, who was really underwater. It took them like 9 months to fail. Silicon Valley Bank was up in flames in less than 72 hours. That's like breakneck pace.
Yeah.
But I also said nowadays, right? You've opened a bank account before, correct? Somewhere?
Yep.
How hard was the process?
Harder than it needed to be, but not really that hard. It just took time.
Right. So if you banked at Silicon Valley Bank and you have a sign of trouble, right? Oh my God, I got $2 million in the bank. This is trouble. Why would you not immediately move your money? It's not that hard to open another account. That's also the problem is, when you had the savings and loan crisis in the 80s or maybe even 2001, it wasn't as easy to open a bank account, right? You have to go into the bank physically, provide documents, probably take a little time to get approved, get it open, get money over. Now you can open a bank online. You can go to Goldman Sachs' online bank. You can open an account in 5 minutes. You get a money wired in there in, I don't know, an hour. So that's what I would have done if I banked at Silicon Valley Bank. I would have been out of there at the first sign of trouble. And everybody else, I think, had the same sentiment, which is what we saw at First Republic and Signatures. People just rip their deposits out before they even have the time to figure out, hey, what's really going on? Because our information cycles nowadays are so quick. And that's the bank runs just lightning fast. And that's what kills them.
Yeah, it's really interesting. I mean, certainly for me, coming from very humble South Africa, coming over here and like watching it, and like, because the other thing, I've been chatting to a lot of VCs and over the last kind of month or so, shit tons of startups. Like really, that's my whole network, and all through the show. And just on that one day, I think I had every Friday I do these shows, and I had 3 cancel because of SVB, and that's just in my tiny little Map Round Show ecosystem network thing. And then I learned that like over half the startups were banked there, like in the US. Like that could, I mean, it was, if you were thinking about a startup ecosystem, systemic, like complete blowout, like that would be it, what I was really grateful to see, because I'm like, holy shit, like what's going to happen to all these people, and what I was really grateful to see was, even though I think it was like 97.5% of the deposits were not guaranteed, like through FDIC. So, because they were over 250,000, like even when I saw that, I'm like, holy shit, like that's really bad. That's like really, 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 it's a total fuck up. It's a clusterfuck. It's a black swan event. And it's interesting to see, I've had a few chats consequently since then, and how quickly it's bounced. Like it became this massive story, and then it was actually fine the next day. Like we would, in developing markets, you would never ever find that. Do you know what I mean? Like it would never happen. That's why I say only in America, which is beautiful.
Yeah. The FDIC came in. I actually view it a little bit different. I think that the FDIC, right? I mean, I did some work, and I obviously didn't have their balance sheet or the information that I'm sure some other banks had. I think that the FDIC, or politicians in the U.S. have talked tough about banking for years. Since the 2008 crisis, the banks have been the enemies. So if you really wanted to drive that point home, you could have said, no, we're not going to backstop anyone. These people are going to get 90 cents back on the dollar because the balance sheet's not that bad. We're going to liquidate. They're going to get it back. And banks are going to learn a lesson. But when the Fed came out and said on Monday, hey, or Sunday night, we're going to backstop banks. I mean, if you are a bank CEO now, you're like, party's on. Let's go. Let's go with some risk on trades because we're going to be backstopped, right? I mean, and then, after First Republic announced today that they're going to get, or I don't know if it's official, but it looks like they're going to get $30 billion in deposits from bigger banks, not the government, but bigger banks to provide liquidity. And I think they'll ultimately get acquired because once your brand is tarnished like that, I mean, there's a crisis of confidence. Your bank's toast. So somebody's going to have to buy their assets up. But for the time being, so then Jan Yellen comes out today, who's Secretary of Treasury, and says, hey, banking system's fine, but not all banks are backstopped. So it's like, wait a second. You just backstop 2 bank failures. You have the regional banks in crisis, and now you decide to come out and say, fire's out, everything's fine. Nobody else is backstopped? I mean, if you're going to backstop them and that's your policy decision, that's fine. It's kind of like a federalization of the banking system where the taxpayers, again, get screwed because the banks get all the profits. These banks aren't going to pay any money back to the U.S. government, but all the losses are backstopped by the Federal Reserve and FDIC, who are funded by, they can say as many times as they want, the FDIC is funded by fees from depositors and from the banks. That's generally true, but guess who the depositors at these banks are? The taxpayers. And it's not the guy who's got $1 million. It's not my fund who's got, a large deposit, or high net worth individuals who don't even pay ATM fees or any account fees. It's the little guy who's got $500 in their banking account or checking account, who's going to get hit with overdraft fees, who's now going to get hit with another account fee to pass off the insurance costs on that. I mean, the little guy in America always gets screwed.
Yep. It's way above my pay grade, dude. I'm just sitting on the sidelines going, what the fuck is going on here? But it's crazy, man. It's crazy. But So let's quickly, I wanted to quickly ask you about the future, considering kind of talking about how things change so quickly and these systemic events. How do you see the role, how do you see the space of venture capital evolving in the next 10 years, say? So at the end of your current fund's life cycle, in that time, how do you see it evolving, and what do you think its impacts will be on the startup community?
Yeah, I think that, venture capital is so important for the global economic ecosystem because it funds companies at the earliest stages. I mean, venture capital drives so much in terms of innovation. I think that actually, with all this AI we're seeing, I think we're going to see funds become a lot more automated. I think we'll see our first AI-driven venture fund in the next 3 years. I think we'll see a fund that's, totally predicated on technology to make investment decisions. That'll be something that's interesting to see. But I think that's what's going to happen. I think people are going to try and automate to a degree and automate a lot of these investment funds. I think that's going to be one of the big things we're going to see in venture capital. I think you're going to continue to see kind of the same investment themes. People are going to continue to be passionate about the climate. People are going to continue to drive software. Generally speaking, as a world, we've been pretty calm since World War II. I mean, there hasn't been a global conflict, but I very see how easily one could brew because you have, Europe on the brink of war with Russia, and you have China and Taiwan in the South Pacific. And, China's coming for that, top superpower spot. Russia probably doesn't think they're out of the top superpower spot. So, what gets underreported too is India and Pakistan. There's skirmishes on their border between two countries with nuclear weapons almost daily. So I think that, we've been very fortunate to have a period of, kind of non-global conflict. But I think that if you have a real economic downturn in this decade, I think you're going to see, I don't want to call it World War III, but I think you're going to see much more global conflict. And I think at some point, right, I think you're starting to see it. I think over the next 10 years, I think you're going to start to see workers push back a little bit. I mean, you see it with some, I don't know that unions are the best idea for Starbucks and other places, but I think that, employees are going to start to realize that, little guys are going to start getting pissed off that they're getting screwed, and they're going to push for change. And I think that, the rapid news cycle and social media tools that weren't around just 15 years ago that are around now are going to help drive some of the change and give those people more of a voice. So I think those are some general predictions, for the venture space over the next 10 years.
Great stuff, Kyle. I want to have a quick bit of fun, so I'm going to give you the keys to the Matt Brown Show time machine. It's amazing. Just don't crash the thing. But if you could go back to yourself, right, on day one, no fund, but you were like, cool, we want to do Backswing Ventures. What advice, if you could go back to yourself on day one, would you give yourself about the space of venture capital investing?
Yeah, I would go out and find somebody who's run a fund before and beg them to help me run my fund from the very first day and explain to me all the things I'm going to learn and all the things I don't know from day one. That's what I would tell anybody who's going to start a fund, is find someone who's run a fund before, even if they serve as an advisor, and really suck as much information out of them as you can.
It's really good advice. Seems like a lot of people are getting into the space, which is quite weird. I see a lot of side notes because you mentioned raising a fund earlier. I've seen even on Instagram, weirdly, it's like, hey, you want to raise a fund? Like you're starting to see it, and it's like, I don't get these people. Like, you know what I mean? Like they're just random people who say they know how to set up and manage one.
I kind of got the opportunity to see that. I was, in the cryptocurrency space in 2017 and 2018 before it really came mainstream. I mean, I remember when Ethereum was $30 a coin and Bitcoin was $600. So I kind of got to see the inner moldings of an early new industry in its infancy. And you could say that venture capital is in its infancy because there's always a new sector, right? I mean, every day there's AI, there's deep tech, there's machine learning. I mean, you go to some of these conferences and they ask you what tracks you're interested in. I mean, I've been in venture now for 3 years. I've been following the community for 10. There's tracks I'm like, I've never even heard of this. This is crazy. This is a new sector somebody just made up. So I think that, there's a lot of people who smell opportunity who don't really know what they're doing. And, running a fund, honestly, is not overwhelmingly profitable until you make your investors money. I mean, you have a $15 million fund, Paul, right? Most funds operate on a 220 model. So your management fee is going to be $300,000, okay, a year. You take that $300,000 where you're going to spend money on due diligence. You're going to spend money on entertainment for investors. You're going to spend money on accounting. You're going to get your tax billed. You're going to have to get K-1s for your investors. You're going to have formation costs. You have all sorts of costs. The only cost that's really passed off to the investors is legal fees. But, just cut that management fee in half. So now you spent all that money on those things. You have $150,000. So now you're responsible for managing $15 million in other people's money and getting paid $150,000 a year to do it. You have the stress of 24/7. You own your business. You're operating your business. You're getting paid $150,000, which after taxes in the U.S., it's like basically $100,000. You're scraping by making $100,000 on a $15 million venture fund. But then when you make investors profit, which if you have a good performing fund, you will, and you get your 20% of the profits, you make your money. But that's 5-6 years down the road. I mean, it takes time to get there. So it's not as glamorous as everyone thinks. You start a fund, people think, oh man, you start a fund and you get rich. You got to perform for your investors to really make money. Otherwise, it's not all that great.
And you know what the worst part about that whole scenario is that you're not even in the driver's seat. You know what I mean? Like, you're like, here's $1 million. Good luck. Like, get me my return. It's like, okay. And you can advise and that kind of thing, but it's not really in your control.
Don't realize that either, right? When you're in venture capital, it's not private equity, it's not investment banking. You're not taking majority stakes in any of these companies. You're going into a company and you're investing at a maximum. Let's say you're buying 20% of the company. So you just become this conduit, right? You have your LPs in one ear who are like, when are we going to get a return? When are we going to make money? Right? I have one investor who asks me every day, are you making any money today? Like every single day. Like something's going to change. Like if something changes, I'll let you know. So like you have people in your ear like that. But it's like, then you go to the portfolio companies and you're like, well, this guy's building a business, right, for the rest of his life. He doesn't want to just sell it. He's building this because he's passionate about it. He wants to run it. He doesn't necessarily want to work for someone else. He might want to IPO. Who knows what he wants to do? He might be making a great salary because they have great cash flows and he just has no need to sell it. So now you're this like awkward conduit and you're in the middle and you're like, man, I got the investors in one ear who are like, I want to make money. I want to make money as a manager. But then you got this guy who's running this perfectly good business and growing it, who's going to make you in the long run. And you've just got to sit there and balance it. You've got to be just enough on the portfolio company to be like, hey, have you thought about a secondary sale? Have you thought about going public? Have you thought about getting acquired? And then on the other side, you've got your investors and you're kind of pushing back on them. And you're like, look, our portfolio is doing really well. The companies are growing. I know we're not seeing dollars yet, but it'll come. Just be patient. And you're just a monkey in the middle for a lot of it.
Dude, I'm never, ever going to be that guy. Like, I'd never, ever do it. Like, I would hate that. It's not, to your point, there's the status of it. What do you do for a living? Well, no, I run a venture capital firm. What's that called? No, it's called Matt Brown Venture Capital. You know what I mean? And then, but meanwhile, like your day to day, it's really not great. I mean, like you're dealing with.
It's not, no. And it's all hours of the night. You're talking to people, financings fall apart, deals blow up. I mean, it's 24/7, right? I was just with one of my best friends. He's a police officer. We were in the Bahamas together. And I was like, he's so envious of like, the amount of money you could potentially make in venture capital, right? I mean, if you take that $15 million fund, you turn it, you make 5 times on it, you're going to make $15 million in management. I mean, that's a lot of money. I mean, the average American's not making $15 million in their entire life. But I tell him, dude, I'm so envious of you because you're a police officer, right? You put the badge and your belt in the locker, you go home. No one's bothering you. It's turned off. It's lights off. Do whatever you want. You're free. It's like being a teacher, anything else, right? You turn the podcast off. Business is done for the day. Well, maybe not because you run your own business, but people get to shut it off. And I say, I'm so jealous because there's some times where you're just like, you just want to shut it off and you become attached to the phone. You're attached to the phone all the time because things happen in real time. I mean, could you imagine if you were on vacation, you're a venture capitalist, right? I don't even have any companies that bank at Silicon Valley Bank. But last Friday, imagine you're on vacation with your wife, your kids, your family, whatever. It's spring break time. And you're sitting there and you start getting those calls on Friday afternoon. Or you don't answer the phone. You go look at it at 7 o'clock on Friday night. And you're like, this is one of the biggest events of the last 10 years. And like, I can't enjoy this anymore. I got things I got to get done. I mean, it's just, so there's no off. So it's not, it's not really as glamorous as it seems. It takes a special type of person to want to do that. And, we're talking about all the good side on it too, right? Imagine if you lose investors' money. Now you have the conscious of, I lost investors' money, and you're but there's a good chance you could get sued, right? Oh, this guy didn't do the right due diligence. He made bad investment choices. Did you do this? Did you do that? Then everybody wants to scrutinize you. I'm very fortunate and lucky that I'm making money and performing well. But for the guys who don't, now you didn't make any money and you've got a nightmare to deal with. It's the nightmare scenario.
Yeah, it's and because it's more the reputation, like, you know what I mean? Like, I was looking at the FINRA regulations around the setup of limited that's what I do now, around limited partnerships and shit. And I was reading I was like, this sucks for the general partner. Like, if it goes south, it sucks for you, dude. Like, the LPs, they're cool. Like they're only, whatever, like they lose their investment. But you as the GP, you the one that's like head on the block.
Head on the block, man.
No. I'd rather be a business broker.
Yeah, there's a lot of ways to make money in finance, but you look at, you can look at the flip side, right? And you look at, the massive hedge funds. You look at Ken Griffin, one of the richest guys in the world, David Tepper from Appaloosa, Stephen Cohen. You look at those guys and they've made it running a hedge fund, which is slightly different than venture, but you look at the founders of Andreessen and Sequoia, they've made it too, right? Peter Thiel made really good money. Billionaire many times over, awesome venture capitalist. So there's you could get there, and it's tough to get there, right? You're never going to get there as a teacher. Unless you're the best investor in history, you're not going to get to that level. It's just not going to happen. But you got to put yourself out there, and you got to take risks every single day to get to that, so-called financial top. And it's tough to do. Like I said, I wrote an article a while ago called "Not Everybody Wants to Be a Billionaire." And when I tell people that, they're like, what? No, everybody wants to be a billionaire. I'm like, no, everybody wants to be a billionaire in the sense that they want a lottery ticket. That, hey, I won the lottery, I'm a billionaire. They don't, to earn $1 billion, people don't want the risk that comes with it. And I know people worth 300 million, 500 million who have no interest in being a billionaire. They want to make 10% on their money for the rest of their life, and they live really, really good. They don't want to take the risk anymore. They've taken risks to get where they are, and they're just out. They don't want to take any more shots. It takes a special person to want to do that, and actually want to do it, not just the financial gain of it, but actually want to get to that level. It's a tall ladder to climb.
Yeah, it's a really great point to end on. Kyle, thanks for being on the show, dude. It's thanks for giving. I've done probably 20 of these things now, and you're giving me a new perspective on the actual day to day. So I appreciate you for that. But guys, check out. Where can they find you, Kyle, if everybody wants to get more information?
Kyle at backswingventures.com. Just go to backswingventures.com. My email's on there. You can connect with me via email. As I aptly said a few minutes ago, I'm connected to the phone.
No, don't do it. Don't mail Kyle. Come to me instead, and then I will give you the good ones, Kyle.
Matt's going to steal all the good deals.
Yeah. Backswing Ventures /Matt. That's the URL, guys. Don't use the email. Alrighty, cool. Thanks for your time, Carl. Appreciate you, man.
Yep. Thanks, Matt.